Well, how's it going, everyone? My name is Amos, and I want to tell you something that's just absolutely crazy to me. Chipotle. They were once a Wall Street darling, and they had a performance that was, in a manner, very similar to Palantir. But now, when we take a look at them, year to date, negative 33.9%. Dude, they're selling off week after week. And here's the reason why I'm interested in Chipotle right now. If we zoom out and we take a look at their stock market performance past 5 years, 55%, not the greatest thing. I'm going to be honest with you, that's kind of low, especially given the parameters of one of the biggest bull markets in stock market history. To me, I don't think that's good enough. But if we zoom out, say 15 years, and we're talking about 1,000%, an ROI of 1,000%, now I'm a happy camper. But if we zoom out 20 years, we're talking about 4,344%. Now, I don't know about you, but personally for me, I like to buy high quality companies on the dip because the data's in my favor for rebound. And when that rebound does happen, well, that's when the compounding happens. But I think the question that I really want to answer is Chipotle a high quality company or not? So in this video, we're going to be taking a look at their numbers, and we're going to be calculating an inherent worth of how much their stock price should be trading for based on their own metrics and fundamentals, and then we're going to be placing them somewhere in the compounder chart, and towards the end of the video, I'll be going over my game plan. But first and foremost, let's talk about what exactly is Chipotle and how do they generate money. So Chipotle is a fast casual, Mexican-inspired restaurant chain that has been around since 1993. And what sets them apart from their competitors is their attention to detail on the ingredients, high quality, and making it healthy enough for a bodybuilder to eat. As a matter of fact, if you're a meathead and you go to the gym like 5 or 6 days a week, a Chipotle is probably one of the more healthier options out there, except probably Cava. And it's also important to note that Chipotle's restaurants are company-owned and operated, unlike McDonald's or Domino's that opt for the franchise business model, which I'm a huge fan of because the franchisees do all of the heavy lifting, all of the work, they run the operations, and then Domino's and McDonald's, they get a kickback, the royalty fees, the licensing fees. It's a very efficient business manner. But on the other hand, Chipotle, they keep everything in-house so that it's standardized and uniform. The company can make all the stores do exactly what they want them to do without having to resort to a 22 or 23-year-old franchise consultant that's straight out of college telling the franchisees what to do. But that also means that Chipotle is going to be on the hook for the cost of procuring the ingredients, the SG&A for the employees, building out each location's interior design, and more. So it's a lot more CapEx heavy. Except for their global branches. All the overseas Chipotle locations are operated by master franchisees that own multiple restaurants within the same geographic region. So now that we all understand Chipotle on a high level, now let's go ahead and talk about the recent developments surrounding the company. There's no way to sugarcoat it. Chipotle's in a pickle right now. Their same-store sales are slightly down when you think about it year over year, and they straight up said that the low-income consumers, they're showing less foot traffic in Chipotle, especially in the months of April to June of this year. That's pretty bad. But between you and me, I don't think that's a unique experience and situation for just Chipotle. I think a lot of the food and beverage companies are experiencing the same thing. And about a month ago, the CEO gave a 30-minute interview on the status of Chipotle, and it was good and it was bad. So I took some notes on what the CEO said. So Chipotle as an enterprise, they refuse to increase the price of their menu anymore. So what you see is what you're going to get for the time being. They're staying put as is, despite activist investors pressuring them to increase everything by 15% or more. And believe me when I say there's a lot of pressure. There's people saying you need to increase the prices of your menu to offset the cost of your ingredients. And I understand where the activist investors are coming from, because if they do increase the menu prices, then their profits will also go up. But whether this is the right or wrong decision, the CEO said Chipotle wants to remain affordable. So they would rather go the route of having repeat customers buying multiple burritos a week for about like $10 a piece, rather than having an occasional customer that comes in, once or twice a month to buy a burrito for like 16 bucks. Now you could disagree with me, but I'm absolutely on the side and the same team as the CEO on this issue, because he's thinking about it with a lens of long-term thinking. It's almost always a better business decision when you think about the long run rather than just scooping up short-term wins. Because the CEO, he's thinking about winning the war that might last 1, 2, or 3 years. Whereas the activist investors, they just want to win one battle within that war. And I don't think that's the right lever to pull right now. If you jack up the prices of your menu when your foot traffic is decreasing, that's And other than that, what else is surrounding Chipotle recently? They just started making the international push into the Middle East and East Asia. That's supposed to be their growth catalyst for the next 2 to 10 years. They opened up branches in South Korea, Singapore, and even Kuwait. Now, why do I say that? Because for the longest time, Chipotle's only been a North America and Europe thing. You can't get a Chipotle in Asia. But now you can. And what's hilarious is Chipotle's actually going to be opening up their first locations in Mexico in early 2026. And I definitely hear you. There's some people out here that are going to be like, why in the world would a Mexican ever want to eat at a Mexican establishment that's Americanized? It's the same thing as why I, as an Asian dude, still go to Panda Express to eat American-style Chinese food. It's why I go to Olive Garden to eat American-style Italian food. Does that make sense? I'm not Italian, but sometimes the American spin and variety and flavors, it just works. It makes the ethnic cuisine a little different. And think about it like this. If they were to make it 100% apple for apple, the Mexican style, and opening it up in Mexico, then their value add and what makes them separate from the competitors in Tijuana or Chihuahua, it's not there. But if it's an American-style Mexican restaurant, I think that's going to encourage people to be like, oh, let's give it a try. I mean, it's opening up in my neighborhood. I mean, it's only $10. Let's go and try their burrito. So if you think about it, Chipotle is rapidly expanding, which is kind of exciting, to be honest, because they have not even entered China yet. And as you know, China has a population that's 3x the size of the US. So once they do open the doors into China, all I'm trying to say is Chipotle's growth story is just getting started. And in terms of optimizing their operations, they're implementing automation into their kitchens as I make this video right now. Because one of my best friends growing up, he worked at Chipotle for 5 years. So I understand how much sweat equity goes into making the food appear in your tortilla wrap or into your bowl. Their kitchen routine has a lot of time-consuming tasks because Chipotle is known for their fresh ingredients that are chopped up in store by hand that day, that morning. The food prep, the kitchen prep is just like a real restaurant. Unlike other fast casual restaurants where everything is just frozen and you just microwave it and you toss that onto someone's plate, Chipotle does everything from scratch. So what does that mean? So right now, grilling their meats take about 14 to 16 minutes on average, which is pretty standard, but they're rolling out new double-sided grills that can cook the meat on top and the bottom. So that's inevitably going to shorten the cooking process in half. And the coolest thing about those double-sided grills is that it's going to tell the workers when the meat is perfectly cooked. Instead of praying on a timer for 14 to 16 minutes, it's going to tell them hey, it's only 5 minutes, but the meat is perfect. Take it out now. And because manually chopping up all of the onions, tomatoes, and cilantro is a lot of work, they're also adding robots right now into their kitchens to increase throughput and efficiency in their operations. Because instead of having 1 or 3 people dedicated to just chopping up the vegetables, one robot will be able to just go ba 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 ba. Now, I live in Japan, and I'll tell you, there's robots in every single chain restaurant here. They pretty much do all of the time-consuming tasks like cooking the rice, chopping up the vegetables, and even delivering your plates to your table. So having firsthand experience of witnessing how much better robots make a restaurant's operations, I feel pretty bullish about Chipotle's future, especially if they integrate the exact same type of robots that are utilized here in Japan. Now, at this point in the video, we're going to be calculating an intrinsic valuation for Chipotle. But before we get to that point, one thing that I do want to call out is when you think about Chipotle's average PE ratio for the past 15 years, historically it has been a 61. And if you only consider the past 10 years, then it's a 64. But if we zoom in and only consider the pandemic timeline up until right now, past 5 years, then we're talking about a 58. Friends and family, take a look at Chipotle's PE ratio right now. It's a 35. So even though they might be expensive on paper, according to their own timeline and history, they're kind of cheap. But it also makes sense why it's at such a low valuation in comparison to like 2020 or 2022. And that's because their same store sales have gone down. And I think that raises the question of whether or not that's going to be a temporary issue or a long-term permanent trend. Like Chipotle is constantly going to be seeing declining sales every single year here on out. But anyways, I don't want to think too negative. So if we think about their EPS for 2025, we only have about 2.5 months for this fiscal year. The projection is going to be $1.23, which is the average estimation from the analysts that are covering Chipotle. And if they finish out the year with a PE ratio that's similar to what they're trading for right now, then by December 20th, December 25th, December 30th, Chipotle could be around $43. But for whatever reason, if they do jump back up to a valuation where the market feels bullish about them, they're reporting their next earnings here in the next week or so. And let's say they blow it out of the water, they crush. Their foot traffic increased, and people are buying Chipotle burritos more than ever. The record amount of sales in that quarter, and they go back up to a 58 PE ratio, then it's not out of the realm of possibilities for Chipotle to hit $71 a share. Now, do I see that happening? Between you and me, I don't want to be a pessimist, but I don't think so. I think somewhere between a 43 and like a 50 sounds realistic to finish out 2025. Now, if we continue to play this game and Chipotle continues to trade for a low PE ratio in comparison to their own DNA and timeline, and let's say in 2028, their PE ratio is a 38, then Chipotle could be $76 a share. But if they do bounce back to having a 58 PE ratio and their earnings per share is $1.68, then Chipotle could possibly hit $117 a share. Now, friends and family, it's time for the compounder chart segment of the video. We're going to be placing Chipotle somewhere on the left or the right in comparison to the other companies that we covered on the channel for the past 5 to 6 months. So if you pause this video and you want to look up Salesforce, you'll find it on the YouTube channel. You want to find Big Bear AI, you'll find it on the YouTube channel. Now, when we think about Chipotle, do you think they're going to be a certified compounder, or do you think they're going to go into the Kager graveyard, right next to Carter's, Baby Clothes, and Chime Finance? Well, here's the thing. I think what's concerning for me is that in the exact same time period, in the past 10 months to 12 months, other restaurants, their competitors, when we think about McDonald's, when we think about Domino's, when we think about Brinker International, which is the parent company of Chili's, Texas Roadhouse, I guess that's all in relation to their sector, because McDonald's year to date, 1.5%, but on the other hand, Chipotle was negative like what? 34%. So at least McDonald's, you're still in the green. And then when we think about Domino's, year to date, negative 6.5%. Pretty rough, so I guess it's not a unique situation to just Chipotle, but their sell-off is more extreme than the competition. And then when we do Brinker International, if we look at them year to date, we're talking about negative 9%. My gosh, it looks like almost every single restaurant is near their 1-year low. Hopefully Texas Roadhouse can break the curse. Do you think they'll break the curse? Let's see this. Nah, they're also negative 9.8% for the year. And just as a reminder, CMG, Chipotle year to date, negative 33.5%. So among the competition, their performance year to date has been the worst, but everyone else is in the red as well, except for the beloved, the tried and true, the blue chip company known as McDonald's. And it's kind of disappointing to see that Chipotle is in the red by the most significant margin, especially when you compare them to their peers, because every restaurant has been battling with higher COGS, which is cost of goods sold. It's more expensive for a restaurant establishment to do business because the cost of meat, the cost of all their various ingredients have gone up due to inflation. Yet, Chipotle, negative 33.5%. It's kind of, if we zoom out 1 year, it's negative 33%. Past 5 years, and at least they're positive, but And the thing is, when it comes to Chipotle, I feel like their struggles started in mid-2024 when it was a social media trend for you to go into a Chipotle and film your POV of the workers making your burrito. And then people would post it on social media being like, oh my gosh, they're skimping out on the scoops, or oh my gosh, the size of my burrito is so small. So much so that in late 2024, a Wells Fargo analyst and his team, they ordered 75 burritos from 8 different Chipotles in order to see if social media was being full of lies or telling the truth. So the Wells Fargo team, they just wanted to know and measure the consistency and quality of Chipotle. And well, his results, not too pretty. They actually found out that if you order a burrito online and you make a digital order, you're gonna have less food. The weight of that burrito or that bowl is gonna be less versus if you would have just gone in person and ordered it, because then they would give you a little more food, because I feel like there's that social pressure of the person watching you make that scoop. So you give them a little bit more. I think that makes sense. What's interesting is, depending on the branch, you'd get less food in person anyway. So it didn't matter if you ordered online or in person. So when this hit piece came out, it hurt their image and brand, like across the business world. I think on social media, their image was already hurting, but now in the business world, everyone was aligned with the masses. That Chipotle's quality control was just all over the place. Sometimes you would get 6 ounces of meat per scoop. Sometimes you got 2.7 ounces of meat per scoop. So consequently, Chipotle's leadership team, they had to do some good PR, and so they made it a priority to increase portion sizes and bigger scoops across the board. Like it was mandated at the end of 2024 and even up to right now, October of 2025. If you go into a Chipotle, the scoop sizes are back to normal and they're going to be pretty generous. But by doing so, it hurt their margins and it led to decreased net income. Because for the exact same burrito, they're shoving more and more food into it. So even if you're generating $10 or $11, depending on what you get, in the past, you would at least have like $4 of profits. Now Chipotle's walking away with like $3 of profits. And so out of curiosity, one might believe that the competitors that are copying the Chipotle playbook, line by line, doing exactly what they do, perhaps they're outperforming Chipotle. Well, friends and family, let's take a look. I think the closest resemblance to Chipotle in the fast casual restaurant space is Cava. Now, how do you think they're doing year to date? Negative 46%. That's pretty devastating. And if we think about Sweet Green, which is basically a salad bowl Chipotle, year to date, negative 76%. So I think my biggest takeaway is that almost everyone in the restaurant space is hurting right now because obviously inflation, the cost of goods sold right now, very expensive for your ingredients, especially the price of beef and chicken. Dude, everything is just more expensive. But also, I think consumers are now pulling back on spending because most of the restaurants, they jacked up their prices in order to make up for the ingredients. And another takeaway that I have is, in comparison to their competitors that are doing exactly what they're trying to do, Chipotle's not as bad. Now, it's bad, don't get me wrong, negative 34%, but with Sweet Green, dude, that's pretty devastating. I mean, at their high, they were roughly $33 a share. They're roughly $7. And for Cava, dude, they were almost $170 a share. It says it right there. Their 1 year high. Now they're $62. Zoom out. Okay, so I guess the 1-year high was last year around December, but my gosh. So Chipotle, I guess it puts things into perspective. I guess everybody is hurting right now. And going back to my business school education, I think in response to the same store sales that are dropping ever so slightly, it's not dropping by like 20% or 30%. Their same store sales dropped by like, I think it was 4%. Now we'll be taking a look at their numbers here in a little bit, but 4%. And I think that's the result of the cannibalism effect. And that's just a fancy way of saying, think about it like this, okay? Instead of just one Chipotle being in town, wherever you're from, now there's 2 or 3 in a 5-mile radius, which decreases the volume and foot traffic at the original location, right? Now the residents and population of that town or city, they have more options and they can go to the Chipotle down the street or the Chipotle that's closer to their work. So as a result, it spreads the foot traffic across its sister campuses. So in a way, it's kind of like Chipotle's getting in its own way. I could be wrong, but it's what I'm guessing. So if, say, one store used to see 100,000 customers in one financial quarter, now they're probably seeing like 97,000 customers, whereas the other store is also seeing 97,000 customers. So in the grand scheme of things, their revenue is still going up. It's just the same store sales is going down. Now, obviously, I could be wrong, but I think this is a cool textbook example of the cannibalism effect. So when it comes to Chipotle, it was really tough for me to decide where they belong. Because when you look at their past, now past performance is not indicative of future gains. That's a really sophisticated way of saying just because they performed well in the past, it does not mean they're going to continue to outperform in the future. And when you think about it, 4,000% in 20 years is just phenomenal. But in recent days, they're experiencing a dip that's pretty disappointing. So I think it really depends on who you are. Do you see Chipotle dropping all the way to $20 a share, $10 a share? For me, I don't see that happening. Now, I don't know. It could, but I don't think that's going to happen. I think right now, seeing as how almost everybody in the restaurant space is struggling, it's not a unique experience for Chipotle. I think this is just a temporary speed bump in their timeline. Like if we fast forward to 2030 or 2040, I think Chipotle will be a lot higher than they are right now. I could be wrong, but it's what I think. So taking everything into consideration, I think Chipotle is going to be placed right there, right next to Adobe, right next to Trade Desk. I would argue Chipotle right now is probably a B-. They're slightly above average given their financials and fundamentals and metrics, but to see negative 34% year to date, you can't really turn a blind eye to that. That's an eyesore. But then again, someone could say that's a buying opportunity. So where does that lead us next? Let's talk about my game plan. And to do that, let's now look at their numbers. For a company that usually has a PE ratio of like a 58 or a 61, their forward trading multiple based on next year's EPS, which is the bottom line per share, we're talking about a 30.7. Now, I hear you. You might say that's very expensive, but the average PE ratio for the S&P 500 is a 31. So Chipotle right now, they're about in line with the rest of the broader market. That is pretty low in comparison to their own timeline in history. Now, if we take a look at the revenue, this is what I was talking about. It is compounding and it is growing at a rate that is simply amazing. Now, you might see this slight little dip from 2015 going into 2016, and that's because back like 10 years ago, I remember when there was an E. coli outbreak from Chipotle locations, I think in Boston or something like that. And so a ton of customers, they boycotted Chipotle, rightly so. Like, would you want to go to a restaurant knowing that they could give you E. coli? So their sales dropped, but did they recover? I mean, obviously they did, right? In 2016, it was $3.9 billion. Trailing 12 months, we're talking about $11.4 billion. So on paper, this company is still expanding and it is growing at a pace that's pretty darn impressive, right? 12.5% year over year growth. That's just the top line. Now, if we take into account their earnings per share, which is the bottom line per share, the growth of that year over year is 18.9%. Just look at the growth rate of their profits per share year over year. I mean, The pandemic, a 1% growth rate, we'll give them a pass. But every year since then, I would argue is pretty darn impressive. What I don't like is that the trend of the growth rate of their EPS is getting smaller year over year, but 19%, not too bad given the conditions and inflationary environment where the cost to do business is really high. At least they're still making pretty good profits. Now, because Chipotle is not a franchise restaurant business model and they're on the hook for all of the operations, this company has a lot of CapEx. Meaning, if we scroll down right here and I show it to you, CapEx is basically all of the equipment, machinery, real estate, all of those costs they have to eat. Now, for the past 12 months, their CapEx is $625 million. That's a lot. So I feel like it's not fair to assess Chipotle by their free cash flow. Likewise, you wouldn't look at a utility company or a water utility company by their free cash flow because they're also CapEx heavy. I think this is where Chipotle really shines. Because even though they do have a lot of CapEx, because they're the ones that are physically building out their restaurants, $1.4 billion of free cash flow. Now, yes, it did decrease by 3% year over year, but that's still very remarkable and very impressive. Given that, if we jump on back over to their income statement, $11.4 billion of revenue, right? But the cost to do business is $8.4 billion. So their gross profit is $3 billion. And of that $3 billion, they're generating $1.4 billion of free cash flow. I really like. So, because Chipotle is a CapEx heavy company, I think a metric that's really important to assess whether or not they are an excellent operation is the ROIC, the return on invested capital. How efficiently they're using capital in order to grow the business. Capital is basically the loans that they take out, the debt that they take on, and the shares outstanding. Their ROIC, I guess this is a glitch, it's not 0%. Their ROIC is 31.9%. Now, friends and family, the golden standard for a decent ROIC is 5%. When we talk about a 10%, that's excellent. When we see a 31.9% ROIC, this is a company that is highly profitable and they're growing their business in a very wise manner. From the ratio of shares outstanding and the debt that they take on, they're growing their business enterprise at a higher pace. So I like their ROIC. And if we jump on over to their balance sheet, right now, Chipotle is pretty flush in cash. They have $1.5 billion of cash, $1.4 billion of free cash flow. And over the long run, it does look like the cash and cash equivalent situation is increasing. But if I show you their total debt, it's going to be high because they're on the hook for building out their operations. It's $4.7 billion. The debt situation is a little concerning, but if they really wanted to, I think they could allocate some of their free cash flow in order to pay down their long-term debt. Now, let's take a look at the same-store sales that people are very worried and concerned about. Now, you would think it dropped by like what, 10%, 20%? Friends and family, I was wrong. I said 4%. Their same-store sales dropped by 0.1%. So year over year, if we take a look at June of 2024, it used to be 3.15 million in sales per location. That's how much money they generate per location on average. Now it's 3.14 million. In the grand scheme of things, I don't think that's so bad, especially given the parameters and conditions that the consumers are living in right now. So when it comes to Chipotle, I think in the near term, like in the next 3 to 12 months, I think it's going to be rough with the consumer weakness and margin issues. And given their high PE ratio of like a 33, 34, 35, I think any further headwinds or any setbacks, it's going to be catastrophic for them. Because when a company trades for a premium, you're usually priced with perfection in mind, meaning you can't really mess up or have any blemish or pimple like I do. I have a pimple right here. You gotta be perfect and flawless. So if something bad does happen, their stock price could drop even further. But long term, when I think about Chipotle and the numbers that they're executing, dude, I feel absolutely bullish given their global expansion. They haven't even set foot into China yet. Just keep that in mind. And I love the fact since 1993, Chipotle's been focused on healthy food because that's the trends right now. Everybody wants healthy. Chipotle's been doing it for 3 decades. So when it comes to Chipotle, I want to tell you this. I don't just look at stocks as stocks, right? Some people say, oh, I'm just going to buy into this and I hope it goes up. Instead, I look at a stock, so in this case, ticker symbol CMG, that stands for Chipotle Mexican Grill. I look at them with the prospect of, should I buy this business or not? Like, do I want to become an owner of this operation? Would I be happy being an owner of this company? Will they print cash? And when I answer that question, for me, I'm not telling anyone else what to do. For me, I like Chipotle. I think they're pretty high quality. I know there's going to be some people who comment down below saying Chipotle is trash, their quality went down. Yes, I think that's the vocal minority because if they were entirely trash, why would they be growing 12.5% year over year for their revenue, right? So I think fundamentally, 80% of the people that walk into the doors of a Chipotle, they're probably satisfied, and that's why they're repeat customers. 3 to 5%, they're probably angry towards whatever happens in their life. They're never satisfied. And then the other people, they're just meh. There's no rhyme or rhythm. They could eat at a McDonald's, they could eat at Little Caesars or Chipotle. They don't care. Now, having said that, I do have a few shares of Chipotle in my own portfolio. So do I want to dollar cost average and add more shares? Do I want to sell out of them? Well, to answer that, I guess I'll ask myself a question. Do I see Chipotle being the best opportunity in the market right now? I don't know. I would almost argue no. I mean, yes, the entire restaurant sector seems to be going on a sell-off, so it does seem kind of attractive, but I think there's other opportunities that I'm more hyper-focused on. I think right now it's Amazon. I think it's Booz Allen Hamilton. I think it's Salesforce. And to a lesser degree, maybe PayPal. But I think given the right price, I wouldn't mind dollar cost averaging into Chipotle. That's something I'm going to have to think about over the next day or so, because the stock market opens on Tuesday, I believe. So maybe I will buy more shares. But that's personally what I'm going to do. I don't want you to follow me. As a matter of fact, do not copy me. So I want to hear from you. What do you think? Do you like Chipotle? Are you bullish about them? Do you hate them? Are you bearish? Are you a shareholder? Let me know. I think a dialogue would be very helpful because for me, Chipotle, they're on my watch list. It's just they're not prioritized. They're on my watch list for a reason. They're in my portfolio. I don't feel like I want to add more shares, but maybe I should because they're at a valuation historically that's really low for them. So I don't know. Anyways, if you made it to the end of the video, I appreciate you. Thank you for taking the time to watch this video with me. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you soon, hopefully.